Warren Buffett's number one rule is deceptively simple: never lose money. But let me ask you something, right? If this is truly his golden rule, why has he held stocks that have fallen 30%, 40%, and even 50%, even during recessions? Why didn't he sell Coca Cola in 2008 or Apple in 2020? Why would the world's most disciplined investor tolerate losses? If his guiding principle is to avoid them at all costs, why does he do it, right? So here's the real question: is it even possible to never lose money in the markets? And if not, what exactly did Warren Buffett mean by this rule? Because by the end of this video, I'll show you how this misunderstood principle has helped Buffett build a $130 billion fortune and over a $500 billion business, and how it can help you protect your capital in any market. So part one, we're going to talk about what does he really mean by this, right? Never losing money. That's his first principle. What does he exactly mean by that? Buffett doesn't equate losing money with short-term volatility. When he says never lose money, he means never permanently destroy your capital. There's a critical difference between temporary price declines and irreversible loss. A correction, a fall of 10%, that's normal. A crash, survive it and you'll recover. But putting money into something that has no durable value, that's how you lose. Buffett isn't afraid of red in his portfolio. He's afraid of investing in things he does not understand, overpaying, and being caught without an exit plan. That's why he is the Oracle of Omaha and the best at what he does, right? He's clearly not about avoiding risk, it's about avoiding uncompensated risk. Part two, what I want to speak to you is a very important principle called as margin of safety. Now, the cornerstone of this principle is something called the margin of safety, a concept Buffett adopted from his mentor, Benjamin Graham. Let me illustrate this. If a company's intrinsic value is $100 per share, Buffett does not want to buy it at 98 or even $90. He wants to buy it at 65 or $70. Why? Because he builds in a margin of error, a cushion that protects him in case he's wrong about future earnings, market conditions, or any business fundamentals that deteriorate. The margin of safety is like having airbags in a car. You don't plan to crash, but if you do, you will still survive. And that's exactly how Buffett's capital has not only endured but multiplied. Let's look at some of the real world examples of Buffett's conviction, right? First, let's look at Coca Cola. In 1988, Buffett invested about 1.3 billion into Coca-Cola, and he held it through multiple market crashes. Today, that stake is worth over 25 billion US dollars. But here's the kicker: he earns nearly $800 million annually just in dividends without lifting a finger. Second, let's look at Apple. Buffett began buying Apple in 2016 when the stock was under pressure and everyone was calling for the end of the iPhone. He poured in billions while many on Wall Street remained skeptical. Today, Apple is Berkshire Hathaway's largest position and has returned over 400% since his initial purchase, adding more than $100 billion in value. What do both these examples have in common? He didn't buy hype, he bought predictability, moats, and pricing power at a price that has left room forever. That's how Buffett obeys rule number one, even in a volatile world. That's his margin of safety that helps him correlate that with the largest concept that he has of rule number one: never lose money. So, why is it that most investors fail, right? Let's talk about that. The average investor, by contrast, pretty much misinterprets this rule. They fear price dips instead of understanding them. They confuse activity with progress and often chase speculative fads, cryptos, meme stocks, options, zero revenue IPOs, hoping to double their money overnight. But in doing so, they risk permanent capital loss. Buffett's wisdom is simple yet pretty brutal that way. It's insane to risk what you have and need for what you don't have and don't need. When you lose money, real money, over time, you pretty much, the only thing you lose in that is you lose time, optionality, and compounded growth. That's the real cost. So, in closing, let's go back and answer the question that we had, right? Is it actually possible to never lose money in the stock market? In the short run, of course not. Every investor, Buffett included, sees red. A lot of us see our portfolios go lower as well. But in the long run, if you define losing money as permanently raising capital, then yes, it is possible. You do it by understanding what you're buying, by demanding a margin of safety, by exercising the patience and emotional restraint that most lack. This way, you can try becoming the next Warren Buffett, if not as much in terms of dollar value, but at least in terms of the principles that he's laid down. He didn't build his empire by swinging at every pitch. He waited studied, struck only when the odds are in his favor. And as he reminds us, price is what you pay, value is what you get. If you focus on value, you can protect your downside. You may never get rich overnight, but over time, you'll never lose when it counts. If this changed how you think about investing, hit that like button, drop a comment. And with the biggest loss that you could have avoided, let me know if you could have followed his rule and saved yourself from that. And don't forget to subscribe. This is just one of the several Buffett principles we'll unpack, and next one might change how you look at your portfolio forever. So see you in the next week. Thank you so much.